QuickBooks Online 2025 Receive Payment Form for Payment from Customer on Account, reducing accounts receivable for an invoice entered in the past. Get ready and some coffee because we're learning how to save time with QuickBooks Online 2025. Here we are online in our browser searching for that QuickBooks Online test drive, looking for a result that has Intuit.com in the URL because Intuit is the owner of QuickBooks. We're going to be picking the United States version of the software and verifying that we are not a robot. I'm going to close that first tab, which is no longer needed. We should now be in the sample company file, Craig's Design and Landscaping. Let's open up the major financial statement reports as we've been doing every time. The reports on the left-hand side in the standards tab under the favorites. We're going to be right-clicking on that balance sheet, opening a link in a new tab, right-clicking the P&L, profit and loss, otherwise known as the income statement. Open the link in a new tab. Let's tab it to the right. Close up the ham boogie. Change the range for a 2-year time frame. 010124 tab, 123125 tab. So we can select the drop down, see it in years, run it. We have 2024 and 25 side by side. Let's go to the tab to the right, run it again, closing the ham boogie. Put that top on the hamburger so I can pick it up without getting ketchup on my fingers. 010124 tab, 123125 tab. Selecting the drop down. We want the years, run it to refresh it. Nothing's currently in 2025 except that $34, including prior transactions that we've entered in prior presentations because we logged out and back in to the sample company file, this time in incognito window. If you don't do that, you will have some of that prior transaction stuff in there if you've been following along, and that might be okay. It might not throw you off. But if you want to log off and log back in, it should refresh itself. And if it doesn't, use the incognito window. We're going to go to the first tab. Now let's select the drop down. We've been looking at cycles within cycles within cycles of the accounting department. This time looking at the customer cycle, the sales cycle. We entered last time the invoice type of form, which is the accrual type of form, the sales form, which increases the accounts receivable. And that naturally leads us to the next part or the next step, which is to receive the payment from the customer. And so the way to envision this, let's look at the flow chart over here before we actually enter the payment so we get this connection correct. So if I select then our flow chart, now this is from the desktop version of the home page, but it's just for the flow of the chart. We're using QuickBooks Online. This is just to look at the flow of the process. So if we're in the customer cycle, then we're in a situation here driven by industry where we have to enter an invoice because that's the custom of the industry, like a bookkeeper or a landscaper or a law firm. When we enter the invoice, that increases the accrual account of accounts receivable so that we can then track the accounts receivable and see whether or not we have been paid or not. Next, what's going to happen is we're going to get paid. The data input form to get paid in QuickBooks is going to be the receive payment form. Now, this one gets a little bit confusing at this point because there's different ways that they could pay us. In other words, we might take the invoice, try to email them the invoice and give them some kind of link possibly to pay us automatically if they could. So we get an electronic transfer, or possibly they pay us to a PayPal account or a Stripe account or a credit card account, or maybe they send us the good old-fashioned check, or maybe they come in and give us cash. So all these different forms of payment have different implications in terms of how it's going to actually, and in the end of the cycle, end of the day, or end of the process, hit our checking account. So when we get this receive payment form, if we have a system where they're going to pay us electronically, possibly, that's going to go directly into our bank account, whether we do that using like the QuickBooks Connect deposit, in which case we might have to use QuickBooks banking system, right? And then they're going to pay us and it goes into that checking account. Then we might be able to automate the system because the invoice should match out to the payment that we're going to receive electronically. And then hopefully we can basically record this and the deposit, or record this as a deposit into our checking account. If we're using electronic transfers to our bank and we're not using like a QuickBooks bank, then again, we might have some kind of link that would help us to basically collect the payment electronically and allow them to pay it directly into our bank account, which would be great, but it might not be as automated for us to record this just from the link that we give them. And therefore, what's going to happen on the banking side of things is it's going to come through to the bank feeds if we connect the bank feeds. So the bank's going to see basically a deposit. So we have this situation of, well, it's possible when we think about the bank feeds that deposit would match up to the invoice, and we can use that matchup to then record the receipt, payment, and or the deposit. So that's one way that it might work. However, you could easily be in a system where we're not using a direct deposit into our checking account, but possibly an intermediary of some sort, even if it's an electronic payment, such as a PayPal, such as a Stripe, or such as a credit card. So if we're using any of those types of payment options, we have another intermediary financial institution before it gets to our checking account. And that's going to cause us another layer of problems, because that intermediary component is going to group the payments together, not one at a time, most likely, but possibly group them together. And then when they put it into our checking account, it's not going to be payment by payment. It's going to be in some kind of grouped format, which means that we need to use some kind of clearing account to deal with that intermediary component. That intermediary component also might have fees that they're going to charge us for the processing of the payments, which we also have to somehow account for. So that means when we record this received payment, it's possible for us to put it directly into the checking account at that point in time, but oftentimes we're going to want to put it into what we call this clearing account, which might be called undeposited funds or funds to be deposited, so that we can then group it out of that clearing account and deal with any payments that need to be made when we then make the deposit, taking it out of the clearing account, putting it into the bank in the same grouping that will be on the bank statement, so that we can easily do the bank reconciliation process. So that's going to be the big key that we want to kind of keep in mind whenever we receive the payments from the customer. How are we getting the payments? What kind of intermediary kind of components are there, and how can we make the reconciliation process as easy as possible by properly grouping the payments to match what's going to come through on the bank side of things, which we will see in the bank feeds. All right, so let's take a look at this. And if we go back on over here, let's first enter an invoice again. So let's go ahead and just enter an invoice, and then we'll receive the payment on the invoice. So let's say this is going to be customer 1 again, and I'm going to have to add the customer because I refreshed the screen. So I'm going to say save it. Now I could send this to them in an email, and depending on what kind of payment processes we have them set up, we can suggest to them ways to pay us, right? With a credit card, with a possibly banking through a QuickBooks or something like that in their actual bank, or with electronic transfer, or the PayPal or Stripe or something like that, or send us a check, whatever it may be. And then we're going to say that we have the customer, the terms, we'll keep it on 1/6. Therefore, it's going to be due on 2/5. And let's say that we're just going to make it a service item. The inventory is not going to be really important for us at this point in time, because that's going to be recorded at this point when we make the invoice, but not when we receive the payment, which is our point of focus this time. I'm going to make it a service item, therefore, and let's say it's going to be for the good old sales price, $100. Service item 1, boom. And let's say sales tax. Let's get rid of the sales tax. Let's say it's not subject to sales tax. All right, make it nice and easy, save it, and boom. Okay, so now we're gonna say, let's say 2 of those again, so they're gonna pay us $200. What's this gonna do? It's an invoice. It's gonna increase the accounts receivable by 200. The other side's gonna go to revenue by 200, driven by the item, which we said was gonna go to the service revenue account. Let's record it and check it out. We're going to save it and close it. Save it and close it. And then if I go to my balance sheet, run it, as we saw in the prior presentation, we should see this increase in accounts receivable. So if I go into that, there it is. There's our invoice for $200. I'm going to go back and then go to the income statement, run it, and we should see an increase to revenue. There it is, increase to revenue. That makes sense. If I look at that in Excel, just to see it in a more transparent format here, receivables went up by 200, and then income went up by 200. So receivables up by 200, income goes up by 200. No cash has been received, even though we've got an increase in the income, which increased net income. We're gonna have to track the receivable in a subledger for that $200 by customer. Typically, we do that internally. So if I go back to my report, I'm going to go back to the first tab, and then we track this in the sales tab, which would be, you might call the customer center. Within the invoices here, we're going to have the amount not due yet. We'll pick up those items. And where's the one that I just entered? There's customer number 1, where we could say we received the payment. So when we get the payment, if it was a physical check or if it was an electronic transfer or so on, we might get the payment here, and then we can record the received payment. Now, just to point out, it's possible that we wait till something clears the bank, right? If it clears the bank, I can go up here and say, let's go into the transactions tab. And that's going to bring in the banking transactions. If we had a deposit and our idea was we'll wait till it clears the bank. Here's like a payment over here, for example. And notice it thinks it's found a match to this one, which might be the invoice that we just made. So then I can go into this one and notice it's categorizing as a match. So it's trying to basically tie this thing out to an invoice. So, and it's invoice number 1080 that we just entered on 1625, right? So if I was to record this as a match, then it's going to automatically record the received payment, possibly to put it into the checking account, or possibly then record the deposit as well and record that transaction. So that's one way that we might be able to set things up. However, you got to be really careful with that, because the only thing the system really knows to match it out is the dollar amount and the date. And so it's not, it might mess up. It might miss the match, right? So, or if you're in a system where, again, you're using some kind of intermediary platform, you might not be able to do that because it's going to go through PayPal or a credit card company or something like that. So in which case you might have to record the received payment forms as you basically receive the payments. So let's do that. Let's go over here and go back to the sales tab. Now, if I got the invoice, I could find it here in the invoices. I could also go into customers and look at the open invoices. So open invoices and credits. And then in customer number 1, there it is. Let's go into customer number 1. And let's say we received the payment. So there's our invoice. Let's say that we got a payment from customer number 1. If I go into the receive payment form, then there's a receive payment. Notice it's connecting automatically to the invoice. That's what a receive payment means. A receive payment form means that cash is going to go up in some way, but it might not be going into the checking account. It might be going into, as is here, the undeposited funds. And the other side is going to go into, is going to decrease the accounts receivable. So really, this receive payment forms means that accounts receivable is going down. That's what it basically means. And the other side is going to go into some kind of payment that we got, some kind of cash, which will be, again, checking account or this clearing account. So here's the invoice. I can actually connect to the invoice. If I go into it, there's the actual invoice, so I can check it out. I can close it out. If I had, let's go back into this and then receive payment. And so there is that. Now, the other way I can go into this receive payment is I might close this out, and I could just go into the plus button and go in invoice. Next step is to receive payment. Now, if that's the case, once I type in the customer number 1 is who gave us the payment, then you're going to see the invoice populate down below. Let's tab through it. Now, we could say, let's say, now again, this up top is going to take you into options for receiving payments online and whatnot. And remember, you can look into setting those options up, and you got to think about what's going to be the cost of setting those options up. Do I want to use a checking account within QuickBooks, which might allow me to link, but I have to use QuickBooks checking? Do I want to set up a credit card, but then you're going to have fees possibly from the credit card company, and then, you know, some other types of electronic transfers and so on, or the good old school check or send me a payment, right? So let's say this happened on 1/7, and then you could have the payment method. So cash, check, so on. Let's just say a check for this point. And then now here we could put it into undeposited funds. I'm going to start by saying, what if we just put it into the checking account? That would be the easiest thing to do, to just deposit it into the checking account, select the invoice, which will record the payment, noting that if they only gave me out like $100, I assign it to the payment, then there would still be an amount still due on this invoice of $100 still, right? So let's say they pay us the full $200. If I put it directly into the checking account, that will make it easier because I don't have to put it into an undeposited funds account. There's some pros and cons to that still, however. Remember that, or note that if I record this form into the checking account, it's not a deposit form. So that means that the checking account is going to have increases that won't simply only be deposits and possibly transfers, but also the received payment form. That's a little bit of an added kind of problem for sorting, which is one reason you might still want to put it through undeposited funds, so that all increases to the checking account will basically be deposit forms or possibly transfers. The other thing that becomes an issue is that what if you're in a situation where sometimes you get checks that will match exactly to the invoice and they won't be grouped together like credit card payments or cash, but sometimes you do also use credit card payments and cash, which will be grouped together, and therefore you're going to have to use this clearing account, right? In that case, you might always want to use the clearing account because that's just going to be the normal process. In other words, it's going to mess you up probably if you have to use the checking account on the received payment form sometimes, and then sometimes you use the clearing account. If you have to use the clearing account, you probably want to use the clearing account all the time, as it's just your normal process. Okay, but let's put it in the checking account now just to check it out. Save it and close it. What happens if I go to my balance sheet now and I run it to refresh it? We can go into the checking account. So in 2025, and there is our payment form. Notice it's an increase to the checking account with a payment form, other than it's not a deposit form. So if I go into it, I can see there it is. All right, let's close that out. The other side, if I go back, is going to be not on the income statement because we already recorded revenue when we made the invoice. The other side here is in accounts receivable. Accounts receivable is going to be going down. So we see the invoice happened and then the payment. That's the full thing, the two forms that are always going to be in accounts receivable. All right, let's go back. Let's go to the first tab. We need a subledger for accounts receivable, tracking it. That's going to be in the detail in the first tab. You can see now that we got a payment, right? So now you've got the original invoice is now marked off as paid. If I go into that invoice, I can see the detail this way too, where it gives you this little track record. If I edit the invoice and go into the invoice, it says paid. It gives me a nice link to the actual payment, so I can link to the payment. Here it is. I can link to the payment here. There it is. And then, of course, I see my invoice here. I can link back to the invoice this way. Or I can close out of this and I can see the payment. Here's the payment. The payment is closed, meaning it's not a credit. Some people would be a credit that would be applied to other invoices. The whole payment has already been applied out. If I go into it, you see the information here. If I go into that, we could see the invoice that has been applied out. So that is great. I'm going to close that back out. We can also search our invoices here. The invoice is no longer open. The invoice would be deposited. It's been closed and deposited here would be the idea. So there it is, boom, boom. And there it is. And you can also search in the all sales. I can search by the invoice, but I already saw that over there. I can also search for the received payment, which is the money received. Now notice QuickBooks, for some reason with this form, they call it different names, right? So like here it is, it's a payment form in the type, and under here they call it money received. And then if you go actually into the form and edit the form, they call it a received payment. So that's a little bit confusion. It would be nice if the name was consistent all the way through, but you know, that's the idea. All right, now let's do another one and put it through undeposited funds. So let's imagine, let's add 2 more invoices, and we'll see the problem that arises when that happens. So let's make another invoice. I'm going to make it customer 2, let's say. Customer 2, we'll save it. And I'm just going to go, boom, this happened on, let's say, the 8th. And we'll say this is service item 1 again. And let's just say that we had 3 of those this time for $300. That's going to increase accounts receivable. Other side go into revenue. Let's this time save and new, so I can enter another invoice, which will just simply be generically customer 3. Let's say customer 3, tab, save, and then we'll tab through this thing. And let's say that now this is going to be, once again, I'll just say service, sticking with our service item. Let's say that's just $100. Boom. And then I can say, all right, now this time I'm going to save and close it. Save and close, go into the balance sheet, scrolling up, run it to refresh it. Now in accounts receivable, we have 2 more invoices that have been entered. So we've got these 2 invoices, boom, boom. Let's go back. Let's go to the income statement. What happened? Donde? Where's my income statement? Let's run it again. Let's go from 010124 tab, 123125 tab, see it by year, and run it. All right, in 2000, there's our service income, $600 for the 2, the 3, and the 1. Okay, let's go back. So that has been recorded. Now let's go to the first tab. Now remember, you could wait till it clears the bank. What if this cleared the bank? Now what if both of those payments happened and they were done with a credit card, or they went through PayPal, or they went through Stripe, or we got cash payments, and we've got both of those payments, and then the credit card company, Stripe, or we, as we took the cash, deposited into the bank in a one lump sum of, what was it, $400. If I wait till that clears the bank and try to use the bank feeds to record it under the transactions tab, banking, when it clears the bank, it's gonna come through here as $400. The problem with that is if I tried to match it, it wouldn't be able to find the match automatically, because it would have to combine 2 invoices together in order to match out the deposit of $400 to the 2 invoices, which was $300 and $100. That's going to be a problem. Also, if it was a credit card, for example, that we received the payment from, there might be fees involved, which is totally going to mess things up, because you can't really record the fees when you're trying to match. So that matching system isn't going to work. We're going to have to record the receipt of the payment. And when we record the receipt of the payment, we probably want to put it into the clearing account so that we don't have this matching problem. In other words, I could have 2 received payments, and even though it's going to hit the bank as one lump sum, in which case I'd still have this matching problem. So what I want to do, I want to go into here, and I want to say, let's go into the sales tab, and let's say that we're going to receive the payments now. So let's go into the invoices, and let's say that we have our payments. So here's customer number 1. These I want to see not due yet. So now we've got customer 2. So let's say we receive the payment from customer number 2. We receive the payment, we get paid. Let's say it happens on the 9th. The payment method this time we can imagine it's cash, but you can imagine a similar problem if it was a credit card or some other form of payment. We're going to get the payment, but it hasn't hit our checking account yet is the problem. If it's cash, it's easy to visualize. We've got actually cash, but it isn't in our bank. If it's a credit card, they paid us with a credit card, but it's in the middle financial institution. It's not in our bank. If they paid us with PayPal, it's in the PayPal account, which we might track internally, or maybe we don't and wait till it hits our checking accounts. If it's in a Stripe account, it hasn't hit our bank yet. So that means that I'm not going to put it into the checking account. I'm going to put it into undeposited funds. Undeposited funds. So what's this going to do? It's a received payment form. It's still going to decrease the accounts receivable, but the other side's not going to hit the checking account yet. It's going to go into this clearing account. I'm going to save and close it. And before I look at that transaction, I'm going to do the same for this one, for customer 3. And we'll say we'll receive the payment. Let's say it's cash again. It's going into undeposited funds. Boom. And we will receive that one. Let's save and close it. And then let's go to the balance sheet and say what happened. Que pasó aquí ahora? We have then accounts receivable should be going down. So if I go into the accounts receivable, same things happening on this side as before, meaning we have a payment form matching out against the invoices. You can see them tying out nicely, each one to each one. I should be able to tick and tie them off. But instead of the other side going to the checking account, we put it into undeposited funds. As we can see here, let's go back. So instead of going to the checking account now, it went into this clearing account. Noting this clearing account is basically cash, a cash type of account because it represents money that we have, but it's just not in our checking account. You might say then, why isn't it under the bank accounts, which under normal financial reporting, this would be cash and cash equivalents up here. And the reason it's not up there is because QuickBooks, if QuickBooks put it up here, it would be acting as a checking account for QuickBooks, which means it would have a register and whatnot. And QuickBooks doesn't want it to have a register. So it needs to call it an other current asset type of account, even though it's a cash account. That's kind of problematic from a reporting standpoint, but it makes sense from that perspective. So when you're adding up cash in other words, tying out to something like your statement of cash flows, if there's something in undeposited funds, you have to add these two and undeposited funds, right? Which is down here. In any case, let's go into undeposited funds. So now we've got the $300 that are in undeposited funds. So that means that now, if I look at my flow chart, we have the invoice, we have undeposited funds. This is not acting as a deposit form in that it's not going into the checking account. It's going into the clearing account. And then we take it out of undeposited funds and put it into the checking account with a deposit form, which means that all increases to the checking account will basically be deposit forms if I use that method, which is nice. And it means that if these two amounts were grouped together because I physically deposited $400, not $300 and $100, or the credit card company, as the intermediary that collected the revenue on our behalf, then paid it to our checking account with $400 instead of $300 and $100, then that's how it would come through. And if the credit card posted something like a penalty or like a fee, I can possibly account for that as I recorded out of undeposited funds. All right, so let's go back on over. So then we would have the deposit that would need to be recorded. So let's go to the first tab. And now the deposit form, if I can find that by going to the plus button, and I can make a bank deposit. So if I go into the bank deposit, QuickBooks has this pretty neat functionality that this bit up here is going to tell us the select the payments included in the deposit. These down here would be if I'm just going to have an account. So in other words, these up here are telling me the stuff that's making up the amount that's in undeposited funds. $2,462.52 over here in undeposited funds, $2,462.52. So I can then check off these two as undeposited funds, and now the 400 is going in directly. Now let's imagine that for whatever reason we had a fee, like if it was a credit card and not cash. credit card company said, I took $5 out, so I'm not going to deposit into your checking account $400, but rather $395. Well, then I can go down here and say it's going to be a bank service charge. Let's say bank fee or something like that. I'll just add it. It's going to be an expense type of account. Oh wait, that's why I'm not gonna say receipt from. I'll just say, let's delete that. Let's just put the account. Bank charge. That's what I want. And let's just say that the payment was for $5. Payment method, payment for $5. All right, -5. Okay. So now you can see the deposit hit in our checking account is going to be $395. And then even though we're matching this out for the 400. So what's this going to do? Deposit form we'll talk more about later, but it obviously increases the checking account. It's going to increase it by the full amount that we're reporting, $395. The other side's going to come out of undeposited funds for $400 and record a $5 fee of the $5. Let's save it and close it. And then I can go back on over to the balance sheet and I can run it. And then I go into my checking account and we can see that, what did I put on the date? I don't know what date I entered it as of. Let's go back on over and go to the plus button, bank deposit, and I entered, well, no, I just needed to refresh the screen. So I'm back over here on the deposit. So if I go back on over, I entered it in the right date. It just didn't pick up to refresh it. So there it is. So there's the $395. So if I go into it, notice it's a deposit, not a payment. It was a payment on the last time. Now I get to see it as a deposit instead of a payment, and it's for the net amount of the $395. That makes sense. Notice that the fact that it's a deposit, if I have all deposits, it's going to make my sorting easier if I wanted to sort by increases by filtering the transactions over here, because I typically would sort by transaction type. And if there's only one transaction type, that'll make it a little bit easier. It's not too bad if there's a payment form as well, but just something I want to point out. And then the other side's going to be coming out of accounts receivable. So I'm sorry, not of accounts receivable. It's coming out of undeposited funds. And notice when it takes it out of undeposited funds, it still ties it out nicely, meaning it didn't take 400 out. It made it one at a time so you can tick and tie them out. And when it put it into the checking account, it put it in as one lump sum so that it can tie out to what's on the bank feeds. And then I can go back on over, and then we had a charge for the profit and loss, which was going to be down here somewhere with the bank service charges, which will be that $5. Okay, one other thing to note, if I go to this first tab, I'm going to close this. I'm going to open the ham boogie. What happens with the bank account? If I go to the transactions, it's going to clear the bank. What we would imagine to clear the bank now is the $395, because that's the amount that we imagine the credit card company, in this case, we're going to imagine put into our checking account, tying the two deposits together and taking out the $5. So that means that we should be able to match. It will be able to match then based on the dollar amount and date of the $395 to what we entered. It won't record anything, however, because we already deposited it. But it will match it, which will help us out with the bank reconciliation. So in that case, we would be doing more of a full service accounting system because we had to record it on our side and then match it to what happened in the bank, as opposed to waiting till it cleared the bank and using the bank feed to actually record something, right? So that's going to be the general idea with the receive payment form. And the second half of the receive payment form here in our simple transaction would simply be it goes into the cash. Goes in here if we use the receive payment form, and then accounts receivable would go down, right? That's if we deposited with the payment form, or we have the intermediary transaction, which means we put it into undeposited funds. We get the cash, we put it into undeposited funds, and then we take it out of undeposited funds and put it into the cash account. So I won't go into that in detail here because we're running a little long on the time, but that's the general idea.